Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We've been coming to you live from the 35th Annual Futures and Options Expo in Chicago from Nasdaq booth 427. Joining me for the segment, Stephen Budge. He is the principal consultant over at Capco, and we're going to focus on phasing out LIBOR and the potential impact on the derivatives markets. Thank you so much for joining us on set. Now, that's an interesting question. LIBOR is eventually going to be phased out towards the end of 2021. Why is this going to happen?
Well, that's the potential goal. It's not
the goal, right?
Yes,
the goal. Two different things.
But the easy answer is market manipulation. The banks have been doing it for years, so that's the quick and easy answer why they're trying to phase it out. The methodology for the calculation has some perceived flaws in it, so those are that's one of the underlying issues with it that they're trying to hope to fix to allow for a little bit more stability. Those flaws are along the lines of the tenors. Basically, they're published every day for those tenors that they're used to build the curves, and the transactions between the banks are only happening 15, 20 times a year in certain cases. So the rate is now basically, a educated guess versus, a stable traded.
So what do they anticipate to replace this with, and what are the potential impacts to the derivatives market?
So each region is going about it with their own working groups. SOFR for the U.S., Sonia, Esther, ECB, and UK. And those working groups are trying to go about the path organically. With the overnight rates, the alternative reference rate products offerings being expanded, pick up the volume, and that will help lead to stability, and then they can eventually get to term rate publishing by 2021 is the sunset of LIBOR is the goal. As of right now, the U.S. and the UK are ahead of schedule from these timelines that the working groups have proposed. There is the possibility that it will make 2021 and it will be replaced. There's also the possibility that we'll end up having two different rates side by side that you can do, and then there's always a possibility that you could just end up going back to LIBOR and it all.
So it sounds like it's a little bit fragmented. How are you advising firms to mitigate risk during this transition?
Well, there's a lot of issues around LIBOR in terms internally at banks and broker dealers and such. It's front office to back, all the way from risk models, pricing, to contracts, even marketing. Everybody's going to have to go in and see what products, processes are affected, and where LIBOR is mentioned, and make those changes. They're going to have to. During the time, they're going to have to build out their modeling and curve build-outs. All that kind of stuff are going to have to be side-by-side production with the current LIBOR structure, and they're going to have to run it until it officially makes a change and be prepared for it. Because if you wait until 2021, you are going to run some
well, almost like waiting for MiFID II. You're running into the same issues if you weren't prepared, and if you're not prepared, then you can't trade, particularly if you're a global bank, broker-dealer, asset manager. Do you think this is going to be a relatively smooth transition? Because from what you're saying, it doesn't sound like the pieces are being put together.
Yeah, I mean, smooth transition, time will tell. With the derivative space, the product offerings, as long as they keep increasing and the volume increases and all that, that will help lead to a smoother transition, during which, in the derivative space, that's going to allow for other business revenue streams internally for the banks between arbitrage and hedging to take advantage of that. But again, it all relies on the fact that the path that they have with the overnight rates and increasing the volume and stability there will lead to term publishing, and it should make a smooth transition, but time will tell.
All right, well, thanks so much for joining us on set, and thank you for joining me throughout the day. We're coming to you from the 34th Annual FIA Expo. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.